Hello and welcome. Today we'll be discussing long and short positions, what they are, and what the difference is. We begin with the long position. A long position is what we most commonly associate with investing. It involves the buying of a security with the expectation that the asset will increase in price. For growth investors, this expected increase in the asset's price is attributable to a predicted increase in the asset's future value. For value investors, on the other hand, the expected increase in price is attributable to the inherently inefficient market finally realizing the true current value of the asset. A short position is a less common investment strategy that involves the sale of a borrowed security. Where investors with a long position are banking on an increase in the price of an asset, investors with a short position are banking on a decrease in the price of an asset. Some growth investors will take a short position on a security when they expect the rate of future growth to decline. Alternatively, value investors are likely to take a short position wherever they feel that an asset is overpriced in relation to its underlying value. In both cases, the hope is that the price of the security declines. But how does a short position work? Well, first, an investor looking to take a short position borrows a security from a broker with the expectation that its price is going to decrease in the future. The investor is obligated to return the security to the broker at a later time. Next, the investor sells the security on the open market. The investor then buys back the security once its price has dropped below the price that he or she initially sold it at in order to return the borrowed security to the broker. The greater the decline in the price of the security from the time that it is sold, the greater the profit to the investor. Consider the example of Seth. Seth is a value investor. He has conducted a valuation of a company called Vegetable Depot and found that its share price is overvalued at $50 per share. Seeing an opportunity for profit, he decides to short one share of the company. In order to do this, Seth borrows one share of Vegetable Depot stock from a broker. Ultimately, Seth will have to return the share to the broker. However, in the meantime, he is free to sell the share he has borrowed on the open market. Seth sells the borrowed share at the going market price of $50, and subsequently the share price falls to $30. He now buys back one share of Vegetable Depot at $30 in order to return the one share that he borrowed to the broker and close his short position. So, by correctly determining that Vegetable Depot is overvalued, Seth was able to borrow one share from a broker, sell it at the going market price of $50, wait for the share price to fall, and then buy it back at the new lower market price, in this case $30, in order to return the borrowed share to his broker. Through this transaction, Seth made a net profit of $20 minus the fee the brokers charge to borrow securities. He did this by borrowing and selling a security when it was worth more, and then buying it back when it was worth less. Now, investors are often hesitant to take short positions due to their infinite risk. In long positions, losses are limited, as the share price can fall no lower than $0. However, in the case of short positions, risk is infinite because there is no upper limit to share price and losses therein. For this reason, stop-loss orders are sometimes used by investors to mitigate the risk of short selling. While stop-loss orders are sometimes used in long investing to instruct a broker to sell a stock at a certain price in order to protect a profit or prevent a loss, they are even more important in short selling. In short selling, stop-loss orders are adapted in order to dictate to a broker a price above which a security will be bought. In review then, a long position involves buying a security in hopes that the price of the asset will increase. It is what we usually think of when we think of investing. On the other hand, a short position is effectively an investment against a company and involves the sale of a borrowed security. Thanks for watching, and as always, if you have any further questions, please do not hesitate to give us a call or visit our website.